In every age, before the crash comes, the signs are there, quiet, coded, and always ignored. 1,637. The tulip market in Amsterdam collapses overnight, erasing fortunes built on borrowed petals. The 29th of October, 1929. Black Tuesday. 16 million shares traded, billions wiped out in hours. The 15th of September, 2008. Lehman Brothers falls, and with it, the illusion that the system was safe. Different centuries, same pattern. Each time, the crowd believed this time was different. Each time, credit flowed like wine, debt disguised as prosperity. And each time, the system reached the same breaking point when confidence, the invisible currency, vanished. The truth is brutal. Markets do not crash because of sudden bad news. They crash because of years of excess built on faith, leverage, and silence. The trigger a default, a rumor, a mispayment only exposes what was already rotten beneath. This pattern is repeated so consistently, it might as well be a law of nature. Every boom plants the seeds of its own destruction. Every mania feeds on a myth that money somehow will keep multiplying forever. But it never does. It inflates, it distorts, and then it detonates. To understand why and to see the hidden mechanism that always turns euphoria into collapse, we need to go back in time. Back to the first great financial fever that infected Europe. Back to the world's first speculative empire. Because the story of what always happens before a market crash doesn't start in the 20th century. It starts in the age of trade winds, ships, and tulips. The year is 1636. Amsterdam glitters with wealth. Ships return from the East Indies laden with silk, sugar, and spice. The Dutch Republic has become the richest trading power on earth and the first to turn finance itself into an industry. In narrow canal-side houses, merchants trade not just goods, but contracts. Paper promises to buy or sell tulip bulbs, flowers so rare they became a currency of status. A single bulb of the Semper Augustus could cost more than a house on Herengracht. One was recorded selling for 5,500 guilders, about 10 years of a craftsman's wages. The tulip wasn't the cause. It was the symptom. The real fever was credit. For the first time in history, people borrowed heavily to speculate on price movements. Promissory notes circulated like cash. Debt fueled demand. Demand inflated price. Then, as always, faith reached its peak. By February 1637, the buyers vanished. Auctions failed. Prices plunged by 90% within weeks. Merchants who had pledged property for tulip contracts faced ruin. The Dutch government intervened, trying to convert contracts into small fines, but confidence was gone. The world's first financial bubble had burst. But the story didn't end with tulips. It had just begun. The idea of leveraging future wealth to amplify present gains had entered the bloodstream of capitalism. The Bank of Amsterdam, established in 1609, had shown that paper credit could expand trade far beyond the limits of gold and silver. Yet it also revealed something darker, that money could multiply faster than value itself. From that point forward, every empire built its fortune the same way. Credit expansion first, crisis later. Britain in the 1720 South Sea Bubble, France in 1719's Mississippi Scheme, America in the 1922 Stock Frenzy, all identical in rhythm, different only in costume. Because once markets discover how to create money from belief, the temptation is too great to resist. The numbers climb, and history forgets what happened last time. October 1929. Manhattan's air feels electric. Brokers shout over the tickers at 11 Wall Street. The Dow Jones has climbed over 400% in just 5 years. Ordinary Americans, cab drivers, and teachers are buying stocks on margin, putting down 10% cash, and borrowing the rest. The era is called the Roaring Twenties. But what's really roaring is leverage. By late summer, over $8.5 billion in margin debt fuels the market, an astonishing sum for a U.S. economy of its size. Newspapers celebrate a new era of prosperity. Even President Herbert Hoover declares, "We are nearer to the final triumph over poverty than ever before." Then, on Thursday, October 24, the whisper begins. Prices slide, margin calls hit traders who can't pay, panic spreads. Banks try to reassure the public, but fear is faster than truth. By Tuesday, October 29, the market implodes. 16.4 million shares traded in a single day, an all-time record. Billions of dollars in wealth vanish before noon. Some investors lose everything within hours. The financial system freezes. Credit collapses. By 1932, industrial output has fallen 50%. 1 in 4 Americans is unemployed. Farmers burn crops they can't sell. Bread lines stretch around city blocks. On the surface, it looks like mass hysteria, a sudden loss of faith, but underneath, a deeper mechanism had snapped. The entire economy had been inflated by debt, layered upon debt call loans, investment trusts, and bank credit, feeding the illusion of infinite growth. Once prices stopped rising, the pyramid inverted. Every dollar of borrowed optimism turned into deflationary pain. Even the Federal Reserve, created in 1913 to prevent such collapses, was powerless. Liquidity drained faster than it could be replaced. Confidence, that invisible glue of capitalism, disintegrated. Yet here's the haunting part. This wasn't new. The same script had played out in Amsterdam, in London, in Paris. Each time, human ambition found new instruments, new technologies, new words, but never new behavior. The pattern is older than Wall Street. It begins the moment money becomes more than metal. When banks discovered they could issue claims beyond their gold reserves, finance became alchemy. Credit could multiply wealth without producing it. Every new layer of debt promised prosperity, but also fragility. The Bank of England in the 1700s did it. So did JP, Morgan's trust empire, in the 1,920 seconds. And in 2007, the shadow banks, hedge funds, mortgage securitizers, and derivatives dealers repeated the ritual on a global scale. The mechanism works like this. 1. Leverage, borrowed money, fuels speculation. Returns rise faster than risk until the collateral shrinks. 2. Liquidity illusion. Markets seem deep and safe because everyone's buying, but when prices turn, buyers vanish. 3. Confidence spiral. Once trust breaks, every promise demands cash. Cash no longer exists in sufficient quantity. In 2008, subprime mortgages worth $1.3 trillion were repackaged into AAA-rated securities. Banks leveraged them 20 or 30 to 1. It looked safe on spreadsheets until the borrowers stopped paying. When Lehman Brothers filed for bankruptcy on the 15th of September 2008, the same invisible chain that once linked tulip traders in 1,920 seconds, speculators snapped again. Interbank lending froze. The global financial system convulsed. Each time, regulators blamed the instruments: tulips, stocks, mortgages. But those were only vessels. The real engine is human belief in perpetual growth. The more stable a boom seems, the greater the leverage built upon it. Confidence expands credit. Credit inflates prices. Prices justify even more credit. Then, one trigger, a default, a rumor, a headline punctures the illusion. Liquidity evaporates. Leverage reverses. The boom unwinds with mathematical precision. This is the hidden rhythm of financial history. The system amplifies both greed and fear with perfect efficiency. It's why crises don't destroy capitalism, they reset it. The pattern never died. It only upgraded. Today, we live inside the largest experiment in financial history. Since 2008, global debt has more than tripled, surpassing $315 trillion. Central banks from the Federal Reserve to the European Central Bank have printed trillions in new money through quantitative easing. Interest rates hit zero, then below zero. The message was clear: borrow, spend, inflate. The cycle restarted. Stocks soared, housing boomed again, tech valuations reached stratospheric heights. By 2021, global equity markets were worth over $120 trillion, more than the world's GDP times 1.5. But beneath that glitter lay the same ancient fault line leverage built on faith. The mechanism never changed. Cheap money fuels risk. Risk hides inside new instruments: ETFs, crypto, private credit. When liquidity is abundant, everyone feels brilliant. When it dries up, brilliance turns to fear. In 2022, as central banks raised rates to fight inflation, the first cracks appeared. Trillions in paper wealth evaporated. Governments stepped in again, just as they did after 1929, after 2008. Each rescue bought time, but never truth. Because the truth is that every intervention deepens the illusion that debt has no cost. Ordinary people, as always, bear the fallout. Inflation erodes savings, housing becomes unreachable, pension funds strain under low yields and rising volatility. The cycle feeds itself. Policy saves the system, but punishes the saver. History's warning is not about tulips or tech stocks. It's about forgetting. The moment society starts believing crashes are impossible, the countdown begins. Money whispers before it screams. And when it finally does, the sound is always the same, the collapse of belief echoing through time.